Hello everyone, I'm Dr. Stock. In this video series, we're learning about options. What we're starting with is talking about buying call options, and through that we're going to develop an initial perspective, and then we'll move out into other perspectives such as buying put options. This video focuses on the vocabulary that you need to know when it comes to buying options. Later on, we'll get into selling options. We'll get more details into some of the other numbers that go on in the background with options. Definitely ones that you want to pay attention to. But we want to start simple, and we want to build on a single perspective and start bringing in other perspectives so that we get a really well-rounded idea of options before we start working with options in the stock market. So I'm excited to tell you what I know. I took a lot of time putting this presentation together, trying to keep it something that's easily digestible for everyone who is new to traders, whether you are the absolute beginner. If so, you want to start with part 1 of this. Part 2, getting into this, is the step up from there, where we take the scenario that was in part 1 and we build onto it in part 2. So definitely watch them in sequence, especially if you are brand new to these sort of videos and this sort of trading style in the stock market. Trust me, it's good advice. So without further ado, let's get ready to rock. Alright, in this video, part 2 of the series, these are words that you must know when dealing with options. And again, we're taking the perspective from part 1 that we're buying a call option. So here's the scenario that's taking place. You would like to purchase 100 shares of common stock in a company whose current price per share is $10 and expected to rise considerably. The two choices you have: 1, go ahead and buy those shares at the open market, and choice 2, buy the call option to have a chance at buying the 100 shares at $10 each. And if you saw part 1 of the video, then you've seen this before, so this is just a reminder. Again, if you haven't seen part 1, go back and watch it. So, furthering from there, we decided that we like the sound of choice 2, buying the call option, because of its mitigated risk. So what else do you need to know? That's where this video comes in and starts to introduce some of that vocabulary. So some of that vocabulary would be the options contract itself. What is it? The contract writer, the contract holder, strike price, expiration, option premium, exercising the contract, the break-even price, out of the money, at the money, in the money, and assignment. So those are all words that we'll look at, and I have each of those broken down for you in basic terms and also in a fuller explanation, and I also have visuals to help out the scenario, so let's check them out. So first we have the contract writer, and the basic explanation here is that the contract writer is the one who is selling the options contract. And I'm not going to read all the way through the fuller explanations, but what I do recommend is that when you see these come up, take the opportunity to pause the video and read through them yourself. It really is important that you use the basic explanation to get yourself started, but you want to work to understand the fuller explanations over time, because that can be a sign that you understand what's going on with options trading better, and means that you're further prepared to start working with options in the stock market. Next, we have the contract holder, and this is the other side of the coin. The person who buys that contract is that contract holder, and so we will be using contract writer and contract holder to describe the seller of the options contract and the buyer of the options contract throughout the rest of this video. Here's a fuller explanation again, and like I said, I'll have these all throughout. Pause the video, give them a read through. It's not something that at the time of this video you need to understand. If you do, great, but if you don't, there's a lot more words, and that's why I have the basic explanations there for you. So give them a read, and just know that there is more to it, that this is not meant to be exhaustive. This is meant to get people started without being overwhelmed. Okay, the options contract itself. This is an agreement that you make between the contract holder, so the person who's buying the contract, and the contract writer, that's the person who is selling that contract. And the thing to pay attention to here is that it's the contract holder that has the right to buy or sell the security. In this case, we're talking about common shares of stock. So when we say about security, that's just the thing that's being covered by the contract. Here's the fuller explanation for you. Again, feel free to pause the video. So now for the visuals. So here's the call option contract writer. This is the person who is selling the contract. So you can read the description there. You know, hey, anyone want to buy this 100 shares of this stock? And so the contract comes into being. So this one contract equals 100 shares. That's pretty much the standard. There are some exceptions to that, but here we don't have to worry about it for right now. Like I said, we're keeping things small, we're keeping them manageable, just so that we can really follow along with what's going on with buying call options. So here's the other person, the person on the receiving end, the one who is buying that contract, the call option contract holder, and there they are. They're going to take up that seller on that offer to have the chance at buying those 100 shares. Next thing you need to know about is the strike price, and we've actually talked about this. So basically, this is the price that the writer and the holder agree upon in order to exchange that security between one another in one way or another. So when we're talking about buying the call option, this would be the agreed upon price to buy that security. Later on, we'll talk about what it's called when it's an agreement where the holder can sell that security. There's the fuller explanation for you. All right, so furthering the scenario, it's still the same exact statements. We still have the writer offering the 100 shares for $10 each. The emphasis here is that the price that the writer's putting out there is $10 per share for the shares of stock of this company. The emphasis here is that for $10 each, that's the offer that's being put out there by the contract writer and the contract holder going to buy that. There's the agreement, the strike price of $10. So the contract writer is going to be selling those shares if they have to, and the contract holder will be buying those shares if they want to. And that price that they're going to buy them at is $10 per share. So expiration date, every contract that's out there, every options contract has an expiration date. They are not good forever. So the date that contract expires, we just call the expiration date, and that's where the agreement ends. And if you want more of an explanation, I just want to keep on tossing that reminder. I'll give a brief moment where you can pause, and then as soon as you're ready, just resume the video. Back to the scenario here. So $10 each sometime soon gets the emphasis. In other words, that's addressing the expiration date. So the expiration date, just an example, Friday, May 21st. Check out what the call option contract holder says. I'm cool with that. This stock is going to be 15 before then. So again, this is going back to the belief that that stock is going to rise in price considerably before that expiration date. So the options premium entering into these contracts is not free. The writer's putting it out there in order to collect that premium, to get paid for putting out that offer for those 100 shares at or above that strike price that's out there. So that amount of money that the contract holder, the one who's buying the contract, pays to the contract writer to enter the contract, that's what the option premium is. And again, if you want more of an explanation, there it is. So now we further the scenario. The writer's saying, give me $1 per share for the agreement, and the power is yours to buy the shares from me. So there's the option premium of $1 per share. It's going to be $100 total, again, because it's 100 shares for the contract. So $1 times the 100 shares is $100, and that's how that total comes about. That is covered in the first video if you want to take a look at it. Exercising the contract. Just entering into the contract does not mean that the contract holder gets access to those 100 shares. They actually have to exercise the contract in order for that to take place. It's important that you know that the contract holder is the one with the right to buy the security for the call option, and that's what we're talking about in this one. In the case of put options, they have the right to sell the security. It's noteworthy that when you look at the fuller explanation that they specify that the holder has the right to make the purchase or the sale, but not the obligation to do so for that underlying security. So now, furthering the scenario, the writer says, the power is yours to buy the shares from me, and the contract holder says, nice, I'm in control. In other words, it's the buyer who makes that determination of whether or not the contract's going to be exercised. So if you're the buyer of a contract, whether that option contract is a call or a put, as we'll talk about in a later video, that power goes to the buyer. And in exchange for that sort of power is the premium that the contract writer receives. So when you look in the table, it says right to exercise the contract, and that right belongs specifically to the holder of that contract, the one who purchased it. So now the scenario changes a little bit. Now we're looking at just the call option contract holder. So when you look at this screen, notice up here at the top, I'll circle it for you. We're talking about the holder. This is the one who bought the contract. And they believe, hey, I got a sweet deal on this. And now the question comes up, when do I want to exercise this thing? And so that's what we're going to address next, is what happens following the purchase of that contract. So you'll need this graph in order to understand what follows with the purchase. So they bought the contract, and when you look at the different stock prices that we have, see this axis down here is the stock prices. So $10 is the strike price that they have. And then we have all this red area down here, all this green area up here. We'll talk about that. The break-even point also gets addressed in this. And we want to talk about these different areas and what we see. Over here are the profits, whether it's a negative profit, so a loss, or a positive profit that the contract holder would stand to gain as a result of exercising that contract. So first we need to address the break-even price. And what you want to know here is that break-even price is a border between loss and profit. And I really want you to take time and read the fuller explanation here. The graph really helps out with the idea, but getting the language in will help you to articulate that idea, especially if you can go and tell it to others, to talk about that break-even price with them. Because talking about it will help to show that you understand it, and it also helps to solidify that idea in your mind. So the call option contract holder here is asking about the break-even price. And what we have for the break-even price is right here at $11. Why is it $11? Well, if you watched the first video, then you would know, or that you would see, and I'm here to remind you just in case you've forgotten, is that it's $10 per share if the contract is exercised, and it's $1 per share for the premium. So $10 plus $1 is $11. So between the share price and the premium price, that sum of those two prices gives us that break-even point that we have right here. So here I'm pointing to the break-even price so that you're aware of it. And he does go on to say, not as good as winning, but not as bad as losing. And that's a little bit of an oversimplification. I just want to toss that out there because some people will have more experience with options who watch this video, and I know that they're going to start talking about intrinsic value and time value and extrinsic value. However, that's outside of the scope of this video. So for right now, just know that if the call option were to be exercised, $11 would be that break-even point where there wouldn't be a loss or a gain. So all that area of loss is down here. Wherever you see this red border, anything from 0 all the way up until we get to 11, just before $11, because that's where the break-even price is, all of that red, if the holder were to exercise the contract, they would be doing it at a loss. And down here's that $100 loss we talked about in the first video, guaranteed $100 loss for any price down there if they keep a hold of that contract to expiration. And then here where it starts to slant up, this is the loss moving closer to even, and then by the break-even point we get to even, and then after that we finally get into profitable territory after the $11 per share. Next we have out of the money. So if we're not at the break-even point, where are we? And well, if for a call option we're below that price for the underlying security, for that stock, then what we have is an out of the money options contract. And this is prices of security where the contract holder does not want to exercise the option contract. Here's the full explanation. Give you a moment to read that. Again, pause the video if you need, and then we'll go right back to the scenario. So back to the scenario. The person says, I'm not paying $10 per share. It's cheaper just to buy those stocks from the market. And again, if we take a look at that, here's where the out of the money happens. All of these prices that I have highlighted down here along this stock price axis that we have, all of those equate to a loss. And remember, that loss doesn't end till up here, but out of the money is anything in this example below that $10 per share that the stock would be trading for. So all these out of the money values, if you really want those 100 shares, then you would go and you would buy those shares from the market directly. You would not use the call option in order to do that at these prices that are below that strike price of $10. At the money is the next one, and here's at the money, and this is where the securities price, in this case the share price, and the strike price are exactly the same. The fuller explanation is not much that more complicated, but it does use a little bit more succinct vocabulary. So at the money, is right at $10, exactly what the strike price is. They're exactly the same. And the contract holder says, I guess it doesn't matter if I exercise the contract for $10 per share or pay the market price. If they're looking for those 100 shares, that's all they're looking for. It really doesn't matter. For people more advanced in options, there's most definitely a difference, and those are, again, for later videos. For right now, this is more about describing what at the money would mean and trying to give you some sort of context behind it along with the scenario that's presented. In the money is the last one, and for in the money, this is when it starts to make sense to exercise that contract. So this is where the price of the security, where they might want to consider it because, well, they start to either lose less or they start to make money off of that exercising of the call option contract. So this is where the contract holder might exercise the contract. Why? Because it's $10 per share, and what they're getting out of it is a higher price in the market. So if you look here, in the money is down here on this side, and you can see all these stock prices that are highlighted in green, and the deeper it goes into the money, such as $14 per share, if that's how much it costs at the market to buy the shares of the stock, those 100 shares, that's $1,400 versus paying just the $10 using this call option contract. So those 100 shares at $10 per share, that's $1,000. So $1,400, again, that's assuming it was at $14. That'd be $1,400 worth of stock for just the $1,000 for the stock plus the premium that you paid of $100. So that's a $300 difference that you would have, and that'd be a $300 gain that you would be making, and that's why this up here lines up with that $300 that we have over here on the chart. Assignment, this is on the contract writer's side. They have the obligation in the call option, the writer has the obligation in order to sell those shares to the holder of the contract. They have to do it. They're assigned to do it. They don't have a choice in the matter. And this happens automatically. This is nothing that the holder has to worry about when it comes to it. It's not like a homework assignment that somebody just didn't do. This is something that your broker takes care of, and that it happens in the background. As soon as you exercise your contract, it puts assignment into play. So, bringing the writer back into this, and the holder is back on the right-hand side here. So this is the person who sold the contract. This is the person who bought the contract. The holder says, all right, this stock's up at 13 bucks. I'm going to exercise my right to those 100 shares. Here's $1,000. So they are paying $10 per share for 100 shares. That's the 1,000 because they already paid that premium. They already entered the contract. And then, as per our agreement, here are your shares. Check out. Maybe we should get cool graphics or something like that when we buy shares of stocks. That would be a lot more fun, I think. In any case, all right, so then we see this little graphic down here for the shares, and you can see here's the money being paid for those shares. So the contract holder is exchanging the cash to the writer, and in exchange, the writer is going to give those shares to the contract holder. And that's pretty much the scenario that we have for buying the call option and exercising that call option in order to get those 100 shares. So here's the vocabulary that we went over. And what you would want to do if you're really interested in moving forward with options is you can go back through this video and you can take notes on it if you want to. Go out and talk to people about these different things. I usually explain it to my fiance, sometimes to my daughters, sometimes to my cats. Whatever it is that you need to do in order to really start to wrap your head around these concepts and these ideas. So to summarize, the options contract is the agreement between the contract writer and the contract holder. The strike price is the agreed upon price in the options contract. The contract has a specific expiration date. The holder pays a premium to the seller in order to enter that contract. The holder is the one with the rights. The writer is the one who is assigned. They have the obligation to fulfill the terms of the contract if the contract is exercised. That is entirely up to the holder to exercise that contract. Out of the money options are not typically exercised because it's cheaper to buy the stock outright on the market. At the money options might not make sense to exercise for varying reasons, and commission fees from the broker whoever it is that you use to trade, if they charge fees in order to deal with options, well, then at the money could make a little bit less sense. There are some other reasons, but they're outside the scope of this video. In the money, options make the most sense to exercise if the contract is going to be exercised. So again, there's lots of different ways to approach this. This is meant to be a single perspective that we build onto over time, so as these videos come out, it will expand your knowledge, and you'll also come back to these videos maybe and watch them again and realize some of the fuzzy edges that there are to some of the things that I'm saying. And they, like I said, they will be filled in over time, and it will become more of a cohesive idea. The break-even price is the price of the security where exercising the contract borders between loss and profit. Hitting that break-even price does not mean that that contract's going to be exercised. Again, that's for a future video. So what's coming up next in the videos? Buying a put option is our next perspective that we have. It's the other kind of option that would be out there, the other basic type anyway. Following that, we start to get into a little bit more advanced ideas of this: time value, time decay, implied volatility, ask price, bid price, liquidity, intrinsic and extrinsic value, and these are all really important, including the option Greeks that we have: delta, gamma, theta, vega, rho. And then we get into the selling side of options, so then we'd be really changing perspectives that we would have. And again, we're going to be adding on to your perspectives over time. Then finally we get into options trading. And then what some people are really waiting for are the option strategies that would follow. And by the end of this series, you might have a much clearer understanding and a much better preparation for starting into the options world in the stock market. So that's what I have for you guys today. I hope that you really enjoyed the video. I hope that you found it informative. Go back and watch the part 1 and then watch part 2 again. Really start to wrap your head around those ideas. Go out and talk to somebody about these things. If you guys want to join me over at the Patreon in my private Discord to talk about these things as well, that link is down in the description. I also have my growth portfolio over there. My dividend portfolio is also available. I also put out a weekly newsletter and a weekly watch list of stocks for which patrons, if they want to add stocks to also be watched, we also can put those on there. It's been a great time. It's been a great source of support, and there's a lot of fun to be had over there. Also down in the description is a link to WEBULL, which is the trading platform that I show in some of my other videos. We'll take a look at it with some of the options in later videos in this series. If you sign up for WEBULL and deposit $100, it'll get you a guaranteed 2 free stocks valued up to $1,850. I get 2 free stocks for the referral. It helps to support the channel and support these videos that I put out here. Thank you guys so much for stopping over. I really hope that you found this informative. If you haven't subscribed already and would like to, go ahead and hit that subscribe button so that we can see anytime more of my videos come out, including the next video to this series. I really appreciate it. Part 3 I think is going to be a lot of fun. Hit the notification bell so you don't miss it. Hit the like button so it helps out the algorithm. Share it with your friends and really help me grow this thing. I appreciate any support that you guys show. I appreciate you sticking around. Always do your research and due diligence. Contact a financial advisor before making any financial decisions. I'm Dr. Stock. Thanks for rocking with me. Now go get that money.